Hey guys, this is Stephanie here. I'm one of the lecturers for the financial literacy curriculum here at U of T. Because I got a lot of emails and messages about this particular topic, I was going to talk a bit about it for the fourth year medical students, the graduating class. But because of the whole COVID-19 situation and being in quarantine, I'm putting the lecture online. So that way people can kind of get an unbiased perspective when comparing the different disability insurance products and just to simplify some of the terms for you guys. So in this lecture, I'll be talking about in what cases would you not need disability insurance and when you need it, the group versus individual plans, knowing the components of the disability insurance contract, things to watch out for, and a case study at the end to kind of just tie things together so that you can kind of see what the break-even point is when it comes to the different products. I do not take any sponsorship, so I don't have any conflict of interest to disclose. So the first question is, should I get disability insurance? Given that all of us graduated from medical school and we invested a lot of time and effort into becoming a doctor and working as a doctor, our job is our main source of income. And so if that is the case for you, you should get disability insurance. If you need to be physically there at work or mentally there for you to do your job, it's something you should get disability insurance for. You can't have someone replace you. Or if you're going to be going into a specialty where it's a high likelihood of you getting injured. And lastly, you definitely should get it if you don't come from a lot of high financial means, and not having your income coming in can place a huge financial burden if you do become disabled. When should you not need disability insurance? Is if you're financially independent already, you have money coming in without needing to go to work. If your family does not rely on your income to have an adequate standard of living. And so when it comes to being financially independent, this is just a graphic that shows that, let's say if you're like 50 and your net worth is 5 million, you did a really good job of saving up a lot of money. You no longer need to go to work in order to go about your day-to-day life. And even though your insurance plan goes until age 65, and you're age 50 and already at this stage, then whether you need disability insurance to cover your income, that's kind of up to you, but probably not. Just some factors you need to consider when getting disability insurance is that your disability insurance is not taxable. So tax doesn't get taken off of the amount you get every month. And so when you're buying disability insurance, you don't have to cover 100% of your income. Only the amount that you need to sustain your basic standard of living. And so that factor depends on how close you are to being financially independent, as I mentioned before, but it also depends on your monthly expenses and your lifestyle. So if you have low monthly expenses to begin with, do you need a lot of disability insurance? Do you need $10,000 every month? Possibly not. And also it kind of depends on how long you are in residency. I'll discuss a little bit about that later on in the case study. Some medical students who are in their first to third year, you guys don't actually need to buy into private companies' disability insurance. At least within Ontario, if you're part of the medical association, you'll get it with your medical association at a much more discounted rate. And that same goes for life insurance as well. I think it's like about 20 bucks a year or something like that when I was a med student. So just some components of the disability insurance that you should know about. So when I'm discussing disability insurance, I won't be using any specific company's names just for the conflict of interest reason. So I'll be referring to the two main types of disability insurance as group plan and individual plans. So when we're talking about group plans, these tend to be cheaper because the funds are kind of pooled out and risk is spread out as a group. It's generally a nonprofit organization if it's a medical association, so you do get a refund on the premiums or the amount you pay. There is a 50% discount as a resident and up to 2 years graduating residency. However, just make sure that if you're in a different province other than Ontario, it might be a different discount. However, being in a group, as a whole, what if in 1 year there's an increase in like mental health claims? So the policy can change based on fluctuations as a group. And with the group plans, they tend to occur in step rates, and that's why they're able to do it for quite cheap. So what this means is that at each age step, so for example, at age 35, your rate will step up and increase, and that goes from 35 to 44 is another step increase, from 45 to 54, and finally from 55 to 65. When it comes to individual plans, these tend to be a bit more expensive just because it is an individual policy based on you, and it does not fluctuate based on the changes when it comes to the group. This does have a discount. So as a first year resident, if you applied in medical school, you do get your first year waived. And there is a 25% discount applied to rates. And so what a level rate means is that at age 32, for example, you chose to get that rate will continue with you and not change based on your age until you're 65 or whenever your plan ends. So now I'm going to go through some buzzwords that you'll hear, and just to kind of clarify for you so that you can kind of know whether these things can apply to your situation or not. The first buzzword you'll hear is the own occupation rider. And what it is that when you are no longer able to work your own occupation or your job, and you choose to do a different job, you can still get paid the income that you received at your own job if your new job's income was lower. So this might be more important for surgical residents or residents who have a lot of procedures. Reason being is that if they no longer have the manual dexterity and they have to switch their career into doing teaching, for example, at least they can still receive their original income as a result. This might be not as relevant comparatively for someone in family medicine, for example. However, it is still something that you should consider because let's say for, I don't know, mental health reasons, you're no longer able to do your job and you switch into something that might be lower paying. You still want to be able to get paid as you did doing clinical work. The cost of living adjustment rider is what it is that once you become disabled and you start receiving your claims, each year it will go up with inflation. I've heard varying things about how useful this is, but just something you should know is that this only comes into effect if you've been disabled after 12 months. So for example, if you were disabled for only 2 months and you want to claim 2 months amount, this might not be really relevant for you. It's more relevant for those who can foresee themselves being disabled for longer periods of time, longer than 12 months. And finally, the future increase option or the guaranteed insurability. So what this is that with each time you want to up your insurance coverage, it allows you to do so without having to go through the underwriting process. And a picture of what the underwriting process is shown here. And basically that term just means doing the physical and the blood work needed to make sure that your medical health is still kind of the same. The other buzzword you'll hear is the elimination period. And what the elimination period is the time when you get injured to the time when the benefits get paid. Generally speaking, for all the insurance that is being sold to you guys, they were all 90 days at baseline. However, it can be shortened to 60 days or 30 days, but at a cost. So it'll make your premiums go up. And just something to emphasize here is that in my previous lectures, I've talked about emergency funds and why they are important. And I've mentioned before that having like a 3-month emergency fund that can cover 3 months of living expenses is important to have. And especially in this case, it's particularly of importance when it comes to not getting paid during your elimination period. You might also hear something called critical illness insurance. And what it is that it covers about 25 acute conditions, for example, heart attack or stroke. And remember when I talked about the elimination period being 90 days? So let's say you need the money immediately within 30 days upon receiving a diagnosis. And so that's when critical illness insurance might come into effect. Keep in mind, it does not cover pre-existing conditions. And it can cover things that you might not have the money for immediately. So for example, if you need accessibility renovations to your home, it can be used towards that. Just the con of getting a critical illness insurance is just that it'll have additional costs to what you have to pay. And these are just some of the types of eligible conditions. It's not all of them, but if you go on the insurance's website, you'll be able to find all of the 25. So there's just some things that you should watch out for that disability insurance brokers might not tell you about. And the main thing I want to emphasize here is during your application, this is what the form, a component of what the form looks like. Number 6, it asks you in the past 5 years whether you've received any treatment, medical advice, etc., specifically for conditions that are mental health related. And the main reason why I want to point this out to you is because mental health tends to be the most claimed thing in residency. And so for a lot of disability insurance companies, their ideal client are people who are, healthy, they're paying into the disability insurance while not actually needing to claim anything. And so a lot of these companies will have these limitations in their plan just to kind of watch out for people who might be at higher risk of claiming their insurance. And so remember how I pointed out to number 6 being all of the mental health conditions. So some insurance plans do have this pre-existing condition limitation. And what this entails is that if you've had any sort of treatment, so for example, within the past 24 months of signing onto that disability insurance, you had an episode of depression. And let's say you got prescribed an SSRI for that depression, and you were fine after taking it. And so let's say during residency, you sign on to this insurance policy, and because of the burnout of residency, it's tough. You find yourself depressed again and looking to take some time off to get treated. Just be very careful, because what this limitation entails is that in the pre-policy period, which means the period before you signed onto this disability insurance, they will not pay any income benefits if you are seeking the benefits for a pre-existing or a pre-policy condition. And so make sure you really read these over and know what you're signing. Because I've seen colleagues who were definitely affected by this, and they were kind of tied. The main thing I want to point out in this section here is that this limitation can be removed after a period of 5 years of having no treatment related to that particular condition. And I don't know why they choose 5 years in particular, but maybe it has to do with the fact that for most residency programs, it lasts 5 years. And mental health is the most claimed issue in residency. I just blocked this part off here just because I didn't want to promote or show any company names in my presentation. So this is just a case study to kind of just tie everything up so that you can kind of understand how I went through the thought process of choosing which disability insurance to go with, which one fits for me, such that you can also figure out how to calculate it for yourself, the break-even point, and which might be more relevant for your demographic. So let's say you take a 25-year-old female graduate, fourth year medical student, newly graduated. For most people, healthy, just like most people, no medical conditions and no smoking. So in this case, she did family medicine residency for, it's a 2-year program, and she made $5,000 to $6,000 per month in that residency program. In the first year out of residency, she made $10,000 to $15,000 per month, just doing locums here and there. And a few years into practice, as she started getting the hang of things, she was making more at $15,000 to $20,000 per month. Her cost of living in residency is $3,000, and as staff, maybe some expenses are increased, so cost of living went up to $5,000 to $7,000 per month. So when she looked into the different plans, the group plan and the individual plan, she looked at the group plan first and went on their website where there is an insurance calculator. She put in her age, 25, non-smoker, and is a medical student, and she's female. And keep in mind, female rates tend to be more than male rates. And because her cost of living was quite low, it was $3,000 per month, she decided to put on $3,000 per month, even though the maximum for this disability plan for residents is $4,000. She had the standard 90-day elimination period and the step rate, which is where the discounted rate applies. And so for her monthly total, it would be $27.70. And so the total yearly cost of insurance is $664. She also chose to get the own occupation and cost of living adjustment just because she was not financially independent yet, and still had to work for a period of time, as she does not have a lot of financial support from family members or parents. When she became a staff after finishing residency, she decided to increase her disability insurance coverage to $7,000. She decided to choose $7,000 because she went with the upper end of her cost of living per month. And also she looked at this PDF document that kind of matched your annual income after expenses with generally how much disability insurance you should get. This is a PDF that you can find embedded within this calculator. If you can't, just leave leave a message in the comments, and I'll see if I can post a link to that PDF. So she chose the 7,000 amount. And then she also had this guaranteed insurability benefit just in case she needed to increase without needing a medical. And so in the 2 years after residency, her annual cost of disability insurance was $845. So after the 2 years, there's no more discount anymore. And so for 7,000, this increased to being $164 every month to an annual cost of $1,970. So she also looked into individual plans as well, and unfortunately for individual plans, they don't come with a calculator like the group plan did. So often you have to email the insurance broker for a quote. When you're emailing them for a quote, provide your birth dates, male or female, as well as whether you're healthy or if you any conditions you have. And make sure you ask for quotes from different brokerages, because technically they should all be selling the same product, the same type of insurance. So if they're giving you different quotes for the same company's insurance product, that's a bit sketchy. Make sure you ask them where the quote, what's the breakdown for the quote, and how much each of the riders cost individually as well. So in this case, when I emailed different brokers. I got, the premium would be $34.09 per $1,000 increase on the residency rate. And I've also gotten, it will have an annual premium of $2,466 on average. So using the numbers that I got from the individual and the group plan, I decided to run them into a calculator tool. And I put this spreadsheet in the description link. That way you can download it for yourself and input your own numbers. And so I ran the numbers for this particular case, the demographics for this particular healthy female, just to see where the break-even point is and which one is more worth it for me down the line. So if I were to look at the numbers more closely, at the age 55, that's when the break-even point would be. So the green line here is the level rate, or the private individual coverage, and the blue line here is the step rate or the group plan. And so this difference in cost is about $66,000 of savings for this particular demographic, when it comes to the level rate compared to the step rate. And just, I'll elaborate this a little bit more in the next couple slides, but these numbers might change depending on your particular demographic and your age, also depending on whether you're in a 2-year or a 5-year specialty. So the big question here is, how do you decide which one is for me? And this is a tricky question to answer because there's so many unknowns. You can't predict what your expenses and your life will be like down the line. So when it comes to figuring it out for yourself using the Excel spreadsheet, generally speaking, how it's organized is on the side, the color is based on each of the steps when it comes to step rate. So as you can see here, once you turn 35 years old, as per the step rate, it will go up in premium costs. Here you would input the rates that you get from the quotes that you get. So if you're in a longer residency program, you might actually be able to take advantage of the residence discounted rate for a longer period of time, in which case that can affect your savings more. And it might make the step rate a better plan for you down the line. When it comes to the level rates, make sure you ask your own broker for these particular quotes. In this case, in my case, like when you look at my numbers, for ease of calculation, I just kept it at 7,000. I don't know if I'm going to need to increase it to more than 7,000, but I chose to keep it at 7,000 because I figured as I become more senior in my career, I'll also be having investments as well, like passive investments that pay dividends too. So I might not be reliant on my own salary as much as I start getting older, in which case maybe I don't need to increase my disability insurance premiums. And so just to kind of sum it all up when it comes to the pros and cons, when it comes to step rates, it might be better for you if you are graduating with high levels of debt and you want that cheaper plan early on so that you can have cash flow early to pay off that debt. Or maybe you want to have that money available to invest. So you can also kind of think about it in terms of opportunity costs as well. So you can either be paying a little bit more into your disability insurance with a savings of 6,000 something down the line, or you could have that money available early on for you to invest, in which case the returns might actually be higher than, or are higher than 6,000 down the line. If you're older when it comes to entering residency or practice. So for example, let's say if you are 32 years old, because it's step rate, technically you'll be paying the same amount as a 30-year-old. Whereas if you had a level rate, the amount you're paying as a 32-year-old will be more than the amount you're paying as a 30-year-old. If you're in a longer residency program and can take advantage of the resident rate, and also if you have pre-existing mental health conditions, as I mentioned earlier, due to the limitations, I wasn't able to find anything online about the group plans and whether they have these mental health limitations as the individual plans. So it's definitely something you should check with your group plan insurance broker about. When it comes to level rate, if you do plan to work longer, then maybe it might be more beneficial to you, because then later on down the line, that's when you'll start seeing the cost savings a bit more. If you already know early on what your monthly income and expenses are going to be, so let's say you graduated from residency much earlier and you already know what your salary is going to be, what your expenses are going to be, and you can take advantage of a cheaper rate by being younger, that might be more beneficial for you. And lastly, if you don't want your policy to kind of change based on what people in the group are claiming, if more people are claiming mental health in 1 year than the next, and you don't want it to fluctuate like that, then maybe a level rate might be more beneficial for you. And so that kind of concludes my presentation. If you have any questions, feel free to ask in the comments. And so that way, if someone else who's watching this knows something that I didn't mention about, or knows something that I don't know, they can also respond as well. And so that way we can share in the knowledge. And likewise, if there's something that's more personal to your case that you want to ask me about, or if you want to ask me something more personally about my decision making in which insurance plan I chose, you can just private message me on Instagram at Breaking Bad Debt. And lastly, if you're an instructor yourself and you're looking to kind of give a similar presentation to students, and you're looking to ask me for my slides or graphs for my slides, feel free to send me a message and I'm happy to share my slides with you. And thank you very much.